So as we enter into 2016, there have been a lot of headlines that suggest caution. Energy prices have been under a lot of pressure going back to the middle of 2014. There have been some high-yield funds that have had some liquidity issues. And I would underscore, however, that the U.S. economy, especially the domestic economy, is in particularly good shape. Consumer debts have come down over the last 5 to 10 years. Our financial institutions are in very strong shape as a result of the risk controls and a lot of the creditworthy controls that have been put into place. And at the same time, a number of categories, including housing, automobile industries, are doing very well. So I would encourage investors to look at a number of the positive aspects in the U.S. economy when they consider their investments and their exposures in the U.S. equity market. My partners and I have been overweight the information technology industry and sector for much of the last 8 years. And we find a lot of companies with great innovation, with recurring revenues, with entrepreneurial spirit and products and services that are dramatically taking share from incumbents. One of the areas where we have a lot of focus in the portfolio is in enterprise security, in essence keeping the bad guys out. We all know about the number of hacks that have been occurring globally, and those seem to be intensifying. As enterprises encourage their employees to bring in their own devices, be they smartphones, iPads, and the like, there are all a number of different gateways that the hackers and the bad guys can access data. And that's proven a real challenge to technology officers globally. So we have a number of companies in the portfolio which are helping companies and enterprises to keep the bad guys out, in essence, and to make our data and our personal information that much more secure. In the strategy, my partners and I have been chronically underweight the healthcare sector because we do not find the early stage biotech business model to be particularly attractive. Typically companies that are capital starved, there may be innovation, but they're years away from commercialization and they're burning cash. Instead, we are participating in the growth of healthcare innovation through a number of companies, either in clinical discovery, in data analytics, in compound formulation, and we've made a number of new investments in the strategy which were opportunistically building up the position on price weakness. Many of the companies that had restrained performance early in this year, including Insulet and Pacira Pharmaceuticals, have rebounded very nicely due to the investments that the company have been taking in their core competencies. Also in the fourth quarter of this year, we had some good performance out of the technology side. Some of our analytics companies, such as Metadata Solutions, have announced a big contract. In the healthcare technology side, Athena, which has been a chronically shorted stock by many prominent hedge funds, reported some very significant enterprise wins and good guidance into 2016. And we also had one takeover in the portfolio, SolarWinds, which was announced in the second half of this year, underpinning that there continues to be attraction by bigger companies starved for opportunity for smaller enterprise companies. Portfolio headwinds in Q4 included a rebound in early stage biotech, which continues to be the biggest subsector of our index. And the other headwind in the portfolio during Q4, ironically, was cash, because we did hold a modest cash position in a rebounding small cap growth marketplace that detracted slightly from our performance in Q4. Small cap growth stocks are traditionally thought of as leaders coming out of an economic recession or market recovery, and that indeed was the case in 08 and 09. And I think in 2016 we may indeed have a case where relatively far along in an economic cycle, small cap stocks will again provide leadership. The reason being that the US dollar has appreciated enormously versus a basket of foreign currencies, and that's really challenged the multinational, the large companies, which are great exporters. Our team believes that domestically focused smaller companies, be they financial institutions, consumer discretionary companies, or technology companies, which don't have that enormous US dollar export exposure, will be the leaders in 2016. So there are a number of uncertainties in the global economy. We think it's crucially important to own companies that are share takers, that don't depend on pricing to grow their profits, and companies that have demonstrated innovation in product or service and continue, therefore, to grow their operating cash flows in a difficult macroeconomy, potentially.